Welcome for apatectv. This session is proceeding about advanced financial management. So thank you very much for tuning apatectv. So remember to subscribe. Click here for subscribe. So you are through with Mr. Evarist. So in today's session we are going to proceed for sure deal. So it is for we are going to collect the question number 3. So the question number 3 to say that the project requires an initial investment in a machine of 300,000, additional cash inflow of 120,000 at current price level are expected for 3 years, at the end of which time the machine will be scrapped. So a machinery will attract tax-arable depreciation of 25% on reducing balance basis, which can be claimed against taxable profit of the current year, which is soon to end. A balancing charge or allowance will be realized on disposal. The tax rate is 30%, and tax is payable 50% in the current year and 50% 1 year in that year. The pre-tax cost of capital is 22%, and the rate of inflation is 10. Assume the project is 100 debt financed. What is the required? The required is to assess whether the project should be undertaken. So let's go to Dupree for making collection. Here in this collection, let us go together each and each. So here we have data given. In our question, you give us the initial investment in machinery, the 300,000, cash in the flows in 3 years is 120. There is no scrap value. The scrap value was not given by the taxable allowance. Allowable depreciation is 25%. The tax rate is 30%. The payable 50% in the current year was 15. In areas there was 15% because it is 50-50, and the tax must be paid 100%. The pre-tax cost of capital is 22. Because they give us the pre-tax, we have to change this pre-tax into the post-tax. So the rate of inflation is 10%. So let's go into deeper by collecting. So here let us start by calculating the writing down value. So here for writing down value, we have time, have detail, have amount, we have taxable saving at 30%, tax saving at 30%, and we have time for tax relief. So we have an initial investment is 300,000, and to calculate the writing down allowance, so we have to take so it is equal. Let me show you how it's work. 3,000 times 0.25%, and also get this is a writing down value, that is a writing down value that to be charged. So that is we are allowed to be claimed. So that is a tax allowable depreciation. So to get the tax saving, we have to get this value 75,000 and times 30%, which is 0.3, and you get this, that is a tax saving. So to get the whitened down value here, we take equal sign, and you take the initial investment less the taxable allowance depreciation. So we get this value of writing down value. For year 2, that is was in year 1, so we are going in year 2. So in year 2, how we get this? So it is equal to this value that is remaining in year 1, and we multiply with the allowable tax allowance, which is 0.25. So and then we get that value. So to get the tax saving here, we get this value we are allowed as a tax allowable, so which is equal to this value, and multiply with the tax that we are allowed, and also we get that value. So to get a written down value here, I can say it is equal to this value remaining in year 1 minus the taxable allowance depreciation, that is equal to this. For in year in the last year, so we are going to say in the last year, because there is no scrap value given to us, so we are going to say this written down value remaining, it is what we sell at the market, that was the written down value. To get here, there is no tax saving, so this tax saving, the tax will be claimed in year 2, tax will be claimed in year 3. So that is how working is. So we are going to the B to show if the project should be undertaken. So we have to calculate the net present value. So remember, subscribe here for apatectv. So we are going to look at this project should be undertaken. So what we are going to do, it is to do this. Here we have details. So here it is a time, where in time here, time 0, time 2, time 1, time 2, time 3. So we have cash inflow. So where that amount of money comes from? In our question, they say that so let us back. They say that the additional cash inflow. This is the cash inflow, the amount that's coming in the business in a current of 1,020 at the current price level are expected for 3 years. That is what we are expecting to gaining to comes in our company. So that's why it is called the cash inflow, which is 120. So because there is no cost, we have no expense with it, so we are going to charge a tax. The tax we are going to charge here, they said that the 50% will be paid in current and 50% will be paid in area. So that's why we are going to take that inflow we get in the year 1 to be charged as 1.5. That's why I use 1/2. So that's going to be paid in this period, and also there's 15 and this. So in areas, that's why the tax to be paid in year 1, because to be paid in area, that is going to be paid in the next year. So that's why we use this and this, and also to get this value. Yeah, we are going to use the time 4, because this tax of this tax will be equal to 1/8, and this, yeah, it is to be paid. So as doing this, we comes to get, when we take this value, get post tax operating for That's why you take this 120, which is equal to this value, raise this and this to be applied in every so you can get, for here it is this. So when it comes to the initial investment was 300,000. That's why we put here value of raise. So, and also the scrap value will be crammed in the last year, so that's why it comes to be this. And also it comes to the tax relief of writing down value, what that is called tax saving, is going to be put here for tax relief. Here it is this value for tax saving to be crammed in here too, as I put here, and this to be put here for year 2, and this to be crammed is 0. Here we will cram 0. So after that we get the free cash flow, where we are going to take equal sign. We are going to take the post operating cash flow. You raise this, and after that it comes for initial investment. You are going to place this value here. Sorry, for this value you can say it is add, because it have the negative sign. That's why we use this. And also we have to add the scrap value. So yeah, for this we have to add the scrap value, because there's the amount of money that's coming in our business. And also we have to add the tax relief, because these are benefits we enter in our company. So that is it is equal to this. So come here and do like this to get the all value. When it comes here for discounting factor, we are using here 27, where it comes from. So for this discounting factor of 27, we cannot use what we have in our question, because in our question they says that we have the pre-tax cost of capital is 22 and the rate of inflation is 10. So we have to add an inflation in our question. So that's why it comes here for this working with number 3, where we use this formula 1 plus I, which is equal to 1 plus R multiply 1 plus H, where R is standing for the given rate, which is real, and the H is a general inflation. So that's why it comes here for getting this value, where will be 27, where you replace for everywhere. So because this after tax, we are going to use the rate after tax will be equal to 15. So that's why I take 22 after tax, and I'm going to make it before tax. For this here, I put this here to get this rate of I. So that's why where this comes from. You want to know where this comes from. That's the question everyone can be asked ourselves. So you have to take 0.22. You raise. You multiply with 1 minus 30% of tax is 3.0. That is 0.7 when you do like this. So it is when I put here equal sign and I say this is this is 1 minus 0.3, which is equal to 0.7, which is equal to 0.7. Later that is why I'm going to multiply with 0.7, and I get 0.850 and 4. That is why I get this. So you come here, you replace where R, it is R, and you put this to get this I. So that's why I used to use this discounting factor of 27 after changing this and after adding inflation. It comes for the table, you get this number, and it is 1 because it's near 0, and this you can get it. And also you look for this number for year 4. Yes, comes for year 4. How it is gonna be. So to get this value, I use this formula 1 plus 0.7, which is this I get, and also I power the number of years I reach in. So I comes to get the present value of free cash flow, which is equal to this value multiply with this value of discounting factor to get this number. And also I can score everywhere to get this. So to get net present value, I take it is equal this plus this plus this value plus this value plus the last one, and also I get this. As you see, the net present value is negative. So conclusion, this machine should not be purchased because it will give us the loss. So that is for the question number 3. That is the final answer you have to give an examiner. So let's proceed for question number 4. Question number 4 is saying that the board of Kigali Limited has approved the following investment expenditure over the next 3 years. This is in a million. So in year 1, that is we are going to spend in this year 2, in year 3. You have identified for investment opportunity which require different amount of investment in each year, details of which are given below. Required investment, that is in a million. In a project 1 we require this and this. In year 2, in year 3 we require this. The cost of capital is 10%. What is the required? From it, the problem of as a linear programming model to show the combination of the projects which will result in the highest overall NPV whilst remaining within the investment constraint. So in this question, what examiner needs, it is need from it the linear programming. So this question is relating to the problem is relating to the capital rationing, where they say that you have the limited investment. That's why we use this. You have a limited investment. You cannot do all the project, or you can do one project or one. So it is where we use this capital rationing to say that this project will be done. So so for question 4, this is what we are going to do. So remember to subscribe for apatectv. We shall continue for the next. Thank you very much. My God bless you. Remember to subscribe, share, like, and comment. We shall proceed for solution in the next session. My God bless you.